Hi, everybody. Hope you're all doing well. Good to see you. You'll notice a change of venue for me. I'm actually in the Appalachian Mountains down here in Virginia. So I finally decided to break out and come visit my family for a couple of weeks and stay put here. So in any case, let me make sure everything is up and running. So please bear with me just a moment. Make sure all the chat's open to everyone. And I'll just send you a quick hello there. And let's just see who we got so far. Well, we got a pretty full house here. Good. Hey, Archie, good to see you. Hope things are going well for you out there in sunny, beautiful Arizona. All right. Lake Havasu. Alicia, good to meet you. Good to see you, by the way, too. All right. Betty, it's always good to see you. Good call today. Bobby, good to see you, buddy. Let's see. David Edwards, always good to see you. Doug, good to see you, too. Hopefully you and Gwen are doing well. Elsa Lay, good to see you, Elsa. Hopefully things are going well up in the Great Northwest. Carrie Burrow, Louis Race. Hey, Louis, I started making, well, you know this because I sent you an email. I started making calls today, Louis, and one or two in Quebec, but the rest I started in Toronto in the afternoon. So we'll have more. I'll have more for you on that in the next week or two. Okay. Melanie, always good to see you. I saw Diane responding to the email about residential assisted living. Hopefully that'll help you out making a connection there. Nicole, good to see you. From the Bluegrass State of Kentucky. Sean, good to see you, buddy. Selena, I know we got a call coming up. Shirley, good to see you. Susan Roberts, always good to see you too. Tom Silvestri. Hey, Tom, by the way, I have that calculator you sent me, Tom. I thank you very much. I have not gone over it, but we're going to bring it up tonight and see how far we get with it. Pretty sophisticated calculator. I like it. Totally good to see you. Willie, good to see you too, buddy. So guys, real quick, let me show you my office here this week, okay? So that's my office. I mean, literally, I get up and every morning do my same repairs, meditate, do my exercises, come out here and eat breakfast. And I go to the far end of the deck where I'm covered by trees and literally work outside the entire day. Pretty awesome. So let's see here. Elsa from BC, yep, exactly, BC and part-time in Bellingham. Melanie, yes, we have a call scheduled tomorrow. Awesome, good, Melanie. Let's see, I think, let's see, is Shika on? Let me check for Shika. Okay, guys, what we're gonna do tonight on this webinar is we're going to continue to go through some of the calculators and spreadsheets. Thanks to some of you for contributing too, by the way. There's one I got from one of my former mastermind members, and then unfortunately we didn't actually have a live version, so Doug Campbell was taking a stab at it, gave us some completed cells, and then I had our VA in the Philippines complete that. So thanks, Doug, for your help there. And Tom Silvestri, thanks for the one you gave me the other week to share. We're going to cover the first one tonight, which is like basically a 6-column comparison spreadsheet on rentals. And what I thought I would do is at some point go over the basic calculations for flipping too, because flipping is a lot easier as far as math goes. There's more risk with flipping, but everybody should understand how do we financially analyze a flip. So if we don't get to it tonight, we'll do that next week. We've also got a lot of other analysis. In other words, we have to do physical analysis. So I'll go over that also. Let's see, today's the 14th. We've got the 22nd webinar, which is next Wednesday, and the 30th, which is the following Thursday. So if we don't complete everything this month on analysis, we'll just roll over into August and continue from there. But one of the things I want to bring up, everybody, most of you are on the team, the Global Investor Asian team, and whether you are or not, when it comes to the workshop, we delayed what we thought we were going to do. Okay, and it's just because of everything that's coming up recently. And I'm not a pessimist. I'm probably one of the most optimistic people I ever meet, but I try to be realistic too. So when I see what's happening in several states, not just because of the increase in numbers, but also they're making up different rules. Different states have different rules now as far as what's allowed. And same thing in Canada. Canada's pretty consistent. But everybody, if you know anything about Quebec, they tend to do things differently up there, and they did certainly with this event also. Toronto had high numbers because it's a giant city, but out in the suburbs and there, London, where I am, I mean, a few hundred cases, and that was it. And now in the farm country, virtually zero cases. But I'm down here in Virginia now. Northern Virginia has definitely had their challenges as of late. But out here in the mountains, I mean, my nearest neighbor is not even in eyesight or earsight. So there's zero cases out here. It's just, it's you have to look at the individual areas. But I'm going to the beach this weekend, Virginia Beach, but not the main part where all the increased numbers are. We have a different area we go to. It's more private. But in any case, long story short, we thought we would be doing workshops back in March. We thought maybe by June or July we can do workshops. And then in May, we thought maybe August, September. So I was hoping for September to do workshops, but I really don't think we are, guys. It's just my gut feeling based on everything we're seeing. I would like to think that we could have the first one in October, November at the latest. If we don't do one by November, I would suggest we wait till the new year. I hate to say it, but you don't want to have a workshop in November and try to have one in December where you have lower turnout and only have one under your belt, and then try to kick it off again in January. It's better, I mean, if we can do one by October, I think we'd be okay. We're just gonna have to take it 1 month at a time is what I'm getting at. So I don't want to go into the workshop until we can actually do one together, right? Where we're all doing it in sync and in cadence with each other, and we can learn from each other. So keep your eyes and ears peeled on that. I'll fill you in later on as we go forward. So in any case, I know we just started up some comments here, so let me check that. Let's see. Carrie, what was the topic? So Carrie, last week, I apologize. Guys, I think I messed up last week. That did not get recorded. And I do the same process, like this is being recorded automatically. I don't know what I did last week. I must have hit a button and just didn't realize it, but it didn't record. So Carrie, last week we went over the two basic calculators for rentals. The one is the online version. The other one is the old standard, we call it the what if calculator. It's an Excel spreadsheet. They're both in the silver level, and they both have, I counted up to, I think it was like 4 webinars I've done over the last 4 or 5 years where we covered those two calculators. So if you go onto the silver level membership area, go into recorded webinars, Carrie, and then now there's a search function. You can actually look and see what the subject is, and just look for Excel spreadsheet or calculator, rental calculator, that kind of thing, and you'll get a couple of webinars pop up. Just download 1 or 2, watch them, and more importantly, download the Excel spreadsheet from the here. I actually brought it up. Let me share it with you. I'm actually there now, so let me do the share function. Hang on just 1 second, guys. There we go. Okay, so this is in there. Oops, I did the wrong thing, sorry. That's the one I want. I'm gonna do share on that. Okay, so Carrie, all you do is you go into silver level, go into forms and calculators. It's one of the tabs here on the left, okay? Scroll down, there's basic cash flow analysis, property inspection report, property rehab analysis. These are the ones we'll do like probably next week, guys, or the week after. But Carrie, here's what I was talking about. This one right here, rental profit calculator, just click on that and download it. Here, I'll just show you real quick, okay? And let me load that up so you can see this one. Share. Is that it? That's not it. Hang on 1 second. Bring this down 1 second. Share. Boy, there it is. Okay, so Carrie, this is the first one. This one we went over last week. Again, it's on the server level membership area. Everybody has access to it. Just download it. You'll see the editable fields. Watch one of the recordings and you'll have exactly what we covered last week. And the other one is this one right here, Carrie. Oops, sorry, let me do share on that. It says real estate investment calculator. It's an online tool. You click on that And as soon as that pops up, I'll do a share. Okay, we'll do share on that. There you go. And all you do, Carrie, is just scroll down, and here's your data entry fields, okay? And this is a little more complex. This is a financial calculator, whereas the spreadsheet is basically like a pro forma type calculator. So one gives you one view. This one gives you a projection over 5 years. That's why we call it a financial calculator. So in any case, that's what we went over last week. And both of those are in the silver level membership area, along with all the recordings of the prior webinars. So let's see, Doug says, good decision. Why don't, yeah, thanks, Doug. Yep. Why don't we use a private room in the XP world for a workshop? David, that is a capital idea, brother. You know what? I think that has a lot of possibilities. So real quick, since David brought it up, this came up back in April, and here's my feeling on this. We can certainly use Zoom to do a Zoom workshop. However, most people will tell you, you don't get as much turnout, you don't get as much engagement, but more importantly, it's harder to kick off the process that's a long-term process with an online form. I'm not saying it can't be done, but what I'm saying is even veterans who are used to doing live workshops like me, when they switch to the online platform, it's not as easy to get engagement and commitment. I mean, we do okay because we're kind of a tight group, and every week it's the same 20 some odd people. So kudos to you, by the way, for being those 20. But generally speaking, numbers drop dramatically. So it's the kind of thing, it might be good to keep it going once it's up and running, but I'm afraid if we start with Zoom, it's really going to be a struggle to get up and running. However, what Dave was talking about, there's an online campus we can go to. It's literally like a virtual room, and you walk in, you see the other people, their avatars, you're having conversations, you can hear other conversations. It's an amazing technology. So David, let's explore that. We should do a call just on that, okay? So let's see, Melanie's actually, what does credit loss mean? Depends on the, let's just Google credit loss, Melanie, because it depends on the context, okay? And I'm not or credit loss, I'm sorry, I did that wrong, please forgive me. Credit loss, that means something different. Credit loss means you lost your credit. Credit loss, count, okay, a loss that a business or financial organization records, which is caused by customers not paying money they owe. So what happens is, so the layman's term is you write it off. Okay, so in the case of like your rental business, like I got a lot of rentals over the years, and we would from time to time had uncollected rent. Okay, so without getting too complex, income coming in on a pro forma basis, we're expecting the income, okay, and we actually account for it. Here's income coming, basically projected revenue. Then you have actual revenue, okay, and then you have revenue you didn't actually collect, but you have to determine when do you move that value from one bucket to the next bucket. Some companies say it's 30 days, some say it's 60 days, some say it's 90 days. What we do is, on a rental business, we don't move it to loss until after we've had a court case. And if we had a court case, even if we won the court case, we evicted the tenant and we still did not collect, then we would move it into credit loss, okay? Because when you're a landlord, when you lease an apartment to somebody, you're basically extending them credit because you had them sign a lease that said over a period of 12 months, they would pay you $12,000, $1,000 a month, okay? So you can count on that income. On your books, you would see that that's incoming revenue, okay? Now, we don't move it over to credit loss just because they're 1 month behind rent. We will definitely go through the process of evicting them, but we don't like to move into credit loss until it's an absolute done deal. There's no way of collecting, but we're not gonna, we'll file a judgment, but we're not gonna spend the energy going to try to squeeze blood out of a turnip, okay? So in any case, now, that's rental business. When it comes to banking, I was in banking for years. You have credit card business, you've got mortgage loans, you got personal loans, all kinds of credits going out the door. and they have different time frames. So on a mortgage, same thing. Just like eviction in a bank, when a property is in default or loan is in default, they won't move that number, that the loan amount into credit loss until they've exhausted the chain of events to foreclose on somebody, try to collect, you know, and they would move the loss over them. They would also then try to sell the property once they took it back in foreclosure. Okay, that would offset the loss. Okay, sometimes the whole thing, sometimes not. Credit cards are probably like, I think 90 days. So it just depends. But basically, when you extend credit to somebody and you don't get paid back, it's a loss. It's a write-off is what it is. So in any case, hopefully that explains things. So if you saw it, Melanie, on one of the charts, like the calculator, it probably had to do with rents. So in any case, excellent question, by the way. Thank you very much, Melanie, for that. So let me go back to the chat box and make sure I'm caught up there. Chat. Okay, let's see. Okay, everything can be done in the world. That's David. Thanks, David. Melanie, a while. Tell me more about that virtual room. So, Melanie, I'm sure you know by now. I'm obviously I'm retired. KW rest of retired, and KW I'm trained KW presenter. But when I rebuilt my team, I rebuilt it at EXP, and EXP has this pretty amazing technology. It's off the chart. It's like the Jetsons come to life. That's what it's like. So Peter Diamandis wrote about this, Melanie, back in 2017 in a book called "The Future is Faster Than You Think," and he specifically pointed this out in the book. And now that platform we use, the founder who used to be KW, Glenn Stanford, bought the platform. He was just foresight, just had the foresight to buy it. Thank goodness to him. He's lucky he did, because now Coca-Cola, GE, they're all going to him to use for Bella. That's the name of the software. Is their online platform. So not how you service clients. So guys, if you're not on the team and you're not familiar with this, let me explain this. Yes, it's a virtual company, but only in operations. So in any company of internal operations, okay, most brokerages up till 2009 were brick and mortar, a horizontal model, which was what KW is, Remax, Century 209, everybody, horizontal model, brick and mortar, okay? A vertical model uses virtual platform for operations, for us meeting internally, and everything's done at the corporate level, disbursement of commissions, processing transactions, marketing, training, educate. It's all done at the corporate level and dispersed vertically through the lines to all the agents. Now, us agents are still serving the clients in the real world, the physical world, okay? And yes, we probably could use Zoom, phone call, texting, the whole 9 yards. That part of the business will never change. That personal relationship with our clients is always going to be there. The technology just makes it easier for us to do that. So EXP, because of Glenn Sanford and his foresight and insight, bought that package and allows us to internally operate with, just like we're doing now, except this is an actual campus online. But it's an amazing. I'll do a special session on that, guys. I'll do a. I'll give you some virtual passes, guest passes, and I'll do a tour. It's a campus with classrooms, and every state has its own boardroom, technology desk, legal desk, accounting desk, and everything's fast. I mean, I don't mean fast like you got to move fast. I mean fast as in the answers are fast. You're not waiting around for a day or two or three for an answer. It's right there on the spot. So in any case, pretty amazing stuff. Let's see. It was on your spreadsheet for vacancy and credit loss. Gotcha. That makes sense. That would be great. Thanks, Melody. Carrie, let's see. Thanks a ton for you're very welcome, Carrie. Glad to do it. David, I've never waited more than 5 minutes for an answer. I agree, David. I mean, I've had legal questions, accounting questions, and it's just like everything is real time. That's what it feels like. It's just the best way to describe it. It's absolute real time. And so we can be more productive and move things faster. So in any case, back to this. Let me go to one of the calculators. Okay. The one I want to go over tonight first is this one. I'm going to actually close out two of my sessions, so we're not going to be held up here. So, okay, let me do a share. Oops, thought I was going to do a share. New share, and where's my calculator? There it is. Okay. So the thing I like about this, guys, is if you look at it, and I'm going to step through it kind of slowly. Let me move my picture of myself up here. Okay. You'll see there's 6 columns here. Now, the way it's laid out is this. Let's say you're looking at a, say a 5-unit building, okay? Generally speaking, the seller or the seller's agent is giving and providing pro forma information. Pro forma means it's a projection. Just remember that. Pro forma doesn't mean it's actual now data. Pro forma means it's a projection of what how the property should perform. So sometimes you're using actual figures, like for me, the purchase price would be an actual number, correct? Gross rental income, that might be based on current market rents for the area, or it could be based on actual rents from the current owner of the subject property, okay? In my cases, what I've done is I would always use actual rents coming in the pro forma, okay? And I would use as many actual figures as I could, but round it off, or I would use averages. My averages would be, though, based on actual figures. So the other week, Melanie asked a question about what's a good expense ratio to count on, is like an average. And if you guys remember, I was saying, well, it depends on other certain factors, like where the property is. In Northern Hemisphere, up in the northern states and Canadian provinces, we've got not only lawn care, we've got snow removal, okay? And we still have pools. A lot of people think we don't have pools up in Canada. We do. A lot of people have pools. I've actually had people in the States ask me if I lived in an igloo. Imagine that. So in any case, in the South, though, in Florida, everybody has pools, okay? But there's no snow. Also in Florida, you've got a lot of, pest control and things like that. In any case, so region has a lot to do with expenses, but also the age of the property was a big thing. So I said, or if I remember correctly, new properties have almost zero maintenance and repairs, whereas properties going back to, close to 1978, and there's let's see, 1978 to say 1990 or 2000 might have a 20% expense ratio. Those 2000 and more current might have a 10% expense maintenance repair ratio. Those from like 60s to 60s and 70s would have maybe 30% ratio. And then those that are like in the 40s, maybe 40% ratio. And those that are beyond that, where you have sandstone sandstone foundations and knob and tube wiring and lead pipes, boy, you could spend half your income on all that stuff, So in any case, averages. My averages are based on actual numbers. I just average them for the subject property. This is what I do when I do a pro forma, okay? Now, actual, just like it says, it's the actual data. So here's what happens. I'm going to paint a picture for you. Let's say Louis has a 10-unit building he's selling, okay? He'll give me the pro forma data, all right? What I'm going to do is, if I show an interest in a property, I'm going to say, hey, Louis, I'm going to make an offer here. I'll give you a letter of intent right now. All right, letter of intent is not an actual contract. It just basically gives you high-level terms, sales price, how much money down, the fact that you'll do due diligence, and you'll get a formal contract in 30 days, and you'll close on it in 6 months, whatever. It's a letter of intent, okay? No money changes hands, all right? What I'll do is I'll say, Lou, I'd like to get the actual last 3 years of rent rolls, okay? I'd like last 3 years of the tax return that pertains only to the rental property. In the States, we call it Schedule E. And I also want the profit and loss from the owner for the last 3 years that shows their own internal profit and loss, income expense, for example. And I'll take those figures and I'll plug them in here in the actual column, okay? Now here's where things get a lot of fun. These what if scenarios. I can change things on the actual numbers, okay? I can change things on the pro forma numbers in these what if columns to see how I can make the property improve better than it is today, okay? So the pro forma figures, as you might imagine, they're always going to make the property look really good. Like right here at the bottom, cap rate says 8.26% based on the pro forma. but yet we plug in actual numbers, we see the actual today cap rate is only 6.42%. See, that's why we get actual figures. But let's say I require a 10% return. I'll use column 1 to figure out what can I do to get a 10% cap rate on this property. You know, I'll raise the rents. I'll extend the term on the loan so it amortizes over a longer period of time, which means I'll have lower payments. I'll add things, you know, whatever, laundry, storage, whatever anything I can do to add additional income. I'll maybe lower my management costs because maybe I've got my own management team. Maybe I'll appeal the tax assessment on the property and lower my property taxes. So there's all these things I can do. And I've got these 4 what if columns to do those what if scenarios in. So you can see what if column 2, which is the 4th column on the spreadsheet, I got myself a 12% return. And then maybe it's 12.5% in the 3rd column. The 4th column, I didn't do anything with, right? So in any case, here's the other reason why I like this spreadsheet. I can actually use this to compare other properties. Maybe some properties I own, maybe properties that have already sold where I was the listing or buyer broker on, or maybe I went and found them online and I called the last real estate agent and said, hey, can I have the actual data for that? So I can compare other properties that are like the subject property. So I don't just have to use this to do what if scenarios on the existing numbers for the subject property. I can use it to compare to other properties, okay? Or let's say I've got 3 other properties I'm looking at, and I've got 4 properties I'm looking at, and I'm going to make a decision on which one I'm going to pursue. I will plug the other 3 in where I already have the numbers, the actual numbers, or my whatever numbers I choose to use, my enhanced numbers based on my improvements and so forth. And I'll have the subject property actual figures and the pro forma from the current owner or their agent, okay? So that's really, I mean, quite frankly, guys, to me, it's a more valuable tool for comparison purposes to other properties I might be looking at than it is simply to do what if scenarios on the subject property. So let me do a quick pause here and see, does anybody have any questions? And we'll go through the pro forma column and change some of these numbers and see how things look. But I just want to make, and you guys are all going to get this. It's actually online in the silver level membership area. So let me see what kind of questions we have coming in. Can you remind me where this is? Yes. So Melanie, hang on just one second. Let me do a, let me go bring that up. Hang on just one second. I'm going to move my chat box over here. So hang on just one second. Oops. Oh, I gotta go down here. Come on, computer. There we go. Okay, so let me bring it up, Melody, just one second, and I'll do a share. Members area, click here. It shouldn't take as long because I'm actually in there now. So let me do a share with you, Melody, and I'll make sure you can see this. Okay, so Melody, what it is, I went to Real Estate with Gary Wilson, the website. I clicked on members area, and once I got in here, I had to log in, and then I clicked on dashboard, okay? And then silver. Ultimately, what I'm getting at is it's in the silver level, excuse me. And on the left-hand side are all of your options, all the different tools and, you know, websites, marketing documents, marketing campaigns, forms and calculators. So we're in forms and calculators. And I click on that, and you should be able to see this. Hopefully you can see this. Yeah, I did do a share, that's right. So if you scroll down, Melanie, it has all these calculators. Basic cash flow analysis, that's real simple, basic stuff. The inspection report's pretty basic. The rehab analysis is pretty basic. We'll go over those, Melanie, we'll go over those next week, okay? Then the rental profit calculator is one of the ones we went over last week. That's the basic one-shot spreadsheet. The quick analysis is what we're doing now. That's with the 6 columns where you can do 4 what ifs. The real estate investment calculator, that's the one that that's the online one we went over last week, because that's where all that is. Okay. Okay, so let me go back here. There it is, and redo my share on that. Okay, so let's play around with this and see what we come up with. Okay, first things first. Purchase price, obviously, let's assume a pro forma, that's the list price for the property. Gross rents coming in, that's the, if every unit was leased, that's the rent you can and should expect for the property. Doesn't mean it's what's collected. Okay, that's separate. But essentially, if everybody paid the rent on time, that's what you would get, $374,100. Let's see, vacancy and credit loss factor, excuse me. So they're combining 2 fields for guys. I don't necessarily like that, but it's 2 different things for me. But it means essentially, in terms of profit and loss, it ends up in the same bucket. So vacancy means the property was not leased. There was no lease on the property, which means that rent should not be showing up in the gross potential rental income. Okay. However, they combine vacancy and credit loss. Credit loss means rent that was not collected. Remember, that was early part of the webinar. So to me, rent not collected doesn't belong in the same category as vacancy. Vacancy means it's not to be expected because it's vacant, it's not leased, okay? But regardless, it's a combined figure of 5%. So that's an editable field. So we can change that to 10%. Whoops, that was 105%. We can change it to 3%. Let's keep it 10% for now. And you can see everything just change below there. So when you change these variable fields, all the other related calculations will change as soon as you hit the enter key, okay? Vacancy and credit loss amount. So in other words, percentage and the amount, let's say that's, I don't know why that should be filled in, 30,000, let's see, 37,410, which is what's used, amount. So what they're saying here, Melanie, is you could potentially write off $37,410, okay, based on credit loss factor, but maybe you don't use it all. Maybe you only account for half of it, and you can maybe postpone the use of the other half for another quarter, right? These are not illegal things to do. These are, and some people call it cooking the books. What you're trying to do is position yourself income expense-wise for the greatest tax position, okay? When it comes to rental properties, I'm gonna probably go down a rabbit hole here. You have expenses and you have capital expenditures, okay? So an expense is something you write off that year. You take the hit in the year you took the expense, okay? And let's just take, for example, maintenance and repairs, okay? Most landlords like to take the write-off the year they took the expense for new doorknobs, for example. Now, according to the IRS, there's things that are considered maintenance and repairs, and there are things that are considered capital improvements. So a new roof is a capital improvement. And a new roof, if you just use the basic tax rules, you would add that cost to the purchase price of the property, what you paid for it, it's called adding it to the cost basis. So if you spend $1 million on a property and you had to replace the roof for $100,000, your cost basis is now 1.1 million. And you would actually depreciate 1.1 million. It wouldn't just depreciate 1 million. In other words, that roof has the same life expectancy as the building itself, 27.5 years. Okay, now, here's some variations here. Let's look at appliances, refrigerators, stoves, dishwashers, microwaves, okay? They're generally assigned a life expectancy of a shorter period than the property itself. The physical improvement, the building, has a 27.5-year lifespan, according to the IRS. It's depreciable over 27.5 years. A refrigerator, though, might be 10 years. Some appliances could be 7 years, some could be 5 years. So really good property owners will depreciate the appliances separately from the building and take that write-off in a shorter period of time. Okay, those things that are it's called cost segregation, by the way. Those things like appliances, you can't take the write-off for an appliance at the year you bought it. You're not allowed to do that. You have to depreciate it over 7 years, whatever that is for a refrigerator. Okay, that's appliances. Now, what's interesting is things that are actually replacing windows, replacing doors, that could add up to be what considered a capital improvement. Did you know that those things you can use? And guys, I'm going to preface this with this statement. I'm not a tax accountant. I'm not a tax attorney. I'm not a tax expert in any way, shape, or form. I'm just telling you what I've done on my tax returns. When you own your properties in a corporate entity like an LLC or in Canada, a corporation, okay? In the United States, you can use what's called Tax Rule 172. In any business, okay, you can take a capital improvement and choose to use Tax Rule 172 and take the entire write-off in the year you made the improvement, okay? Now, really savvy rental property owners, real estate investors, know that, and they will buy their properties all within LLCs. And then hence it's a business. LLC is a business to the IRS. The properties are now assets in the business, not the business itself. So the property is not the business, the property is an asset in the LLC. And they construe that to mean you can use Tax Rule 172. And I've had tax accountants tell me they don't do that and you can't do that. But I have tax accountants tell me that absolutely you can. And we do, okay? I'm living proof, I've done it. So in any case, back to what I was talking about before. These credit losses, you can determine in your fiscal year when you want to take them. And I don't know this because I haven't done this, Melanie, but there may be an opportunity here to roll this loss over into another year. You see what I'm saying? Okay. Now that part, don't quote me on that because I haven't done it, but I'm here to tell you that's a probability. Okay. Or I should say possibility, excuse me. In any case, that was a long answer to a very good question. Let me go back to the chat box because I see some chats coming in. Let's see. Let's see. Remind me where this is. Okay. We saw that was Melanie, Dave. All right, Dave. Good to see you. Okay. The potential rental income increased by 62,000-ish. Where would you find that much income? Whoops. That was not considered by current owners. Oh, I see what you're saying, Louis. So over here in the what if categories, 1, 2, and 3, that might be because Louis, I realize I can add garages to the property. I can convert garages. I can separate the garages from the rentals, from the apartments, excuse me, and rent them off in separate leases. So in other words, I would keep the rents the same in my apartments, lease out the garages separately. And I do that all the time, by the way. So I've even had buildings, 70, 80 unit buildings where there's garages underneath and the tenants were used to putting their cars in there for nothing. They wouldn't pay anything for the garage. The old owner just made them part of the lease for the apartment. And I said, well, you're crazy. I'm gonna separate them. So I did. And I started charging $100, $150 per month for the garages. And as the leases came due for their apartments, I would tell the apartment renters, say, look, these garages are being leased out separately. You have the option to lease the garage separately if you want to for $100 a month, whatever. If not, I'm going to put it out on the market, lease it to somebody else, and I got my money. So that's one way to increase rents. In other situations, I would take basements instead of sitting there empty, other than having the electric panels and the water tanks and furnaces and all that. I would build storage structures in my basements and rent those out for $50 a month, $75 a month, even $100 a month. Okay. I've had buildings where I would take common hallways, if they were wide enough, knock out a door from one of the adjacent apartments, a doorway into the empty space in the hallway, wall off the hallway, and that would add another room to that apartment. And I would do that 10, 12, 16 times in a building and add another $100, $200 to the rent for the apartment. And I've got another several $1,000s of rent coming in. We've also converted attics into additional rooms, sometimes in completely separate studios. We've added laundry facilities. So all those things can generate a lot of additional income. Great question, by the way. Thank you. Let's see here. We got lots of questions coming in. Let's see, Melanie. Great question, Louis. Okay, it's an either or. I'm not sure what that was referring. It might have been a prior question or answer. But it says that was great information. I'd love to learn more about tax write-offs, etc. Do you ever? Whoops, hang on, just lost that one. Do you ever cover those tips in your webinar? That's a great idea. What I can do is this. I will see if I can get my tax accountant to come on, and we can go over some of those, Melanie. I can go over what I know, what I've done on my own returns, and I can certainly share those. But this guy's been in the business, I mean, my gosh, probably 40 something years. And he used to be an investor himself. That's why I like him, because I know he knows what it's like to own properties. I'll see if he would be willing to do that. And I'd like to also get my attorney on too, Cliff Tuttle. Guy's been a real estate attorney for 40 years. Having him come on would be wonderful. Yeah, boy, these guys are. I mean, I way more than 20 years. I mean, we've become friends. You know, they're like close to my dad's age. Let's see, referring to vacancy. Whoops. If you enter 5%, then 37,410 only will show the 5%. Yeah, so let's do that. Let me get rid of this, that hard written figure. Let's type that back in and make that 5%. Hit the enter key, and there you go. Went down to 18,705. Okay, so back to this other income not affected by vacancy. So what would be other income not affected by vacancy? Well, let's talk about what would be affected by vacancy. That would be laundry. So if you have a lot of high vacancy rate, that means not as many people are using your laundry, so you have less laundry income. I would say the example I gave of spinning off the storage separately and the garages separately, that would be an example. So if I had a high vacancy rate in my apartments, I still probably got the garages rented out. So that's an example of something not affected by vacancy. You know, other income, I could potentially have what's called a floater account where I'm playing the float, and I would take income that may be used for expenses in the next month, but put it in a float account at the bank where it's invested, and it would give me a return. And by the way, in banks we do this even on a one-day basis. So we'll let people take their float, what we call float, from their business, whatever it is. Could be laundromat, could be a restaurant, could be a big corporation. We'll load it in this float account. We'll invest the float, even just overnight, one night, and get enough return that it was worth all that effort. Well, that type of return would not be affected by vacancy. Okay. Another thing here, effective gross income. We can see right here, we took the gross rental income, what's possible, gross potential income. We subtracted our credit loss, i.e. rents not being paid or vacancies, and we're left with, then we added back in income not affected by vacancy, and we're left with effective gross income of 356,595. So if you take this, add that to it, add the 18,705 to it, you got 374,10. Okay. Now, operating expenses is a ratio of effective gross income. In this example, 63.66%. That's a lot. Now, remember, to me, in most cases, operating expenses do not include debt service. Operating expenses do not include the principal and interest portions of mortgage payments, okay? So we still got to pay the mortgage payment on this thing. Any case, right now, according to the pro forma, that's 63.66%. That's pretty high, all right? And as far as actual dollars, it's $227,000, okay? Net operating income is 129,000. So if we take the 374, subtract the 18,705, add back in the 1,200, We get 356, 595. That's the money we actually got. Okay. Then we take off. We're left with 129,595 for a cap rate of 8.26%. And just to do a recap on the cap rate. So cap rate is taking this 129,595 of your net operating income and dividing it by the purchase price of the property. Okay. So you take your NOI, divide it by purchase price, and that gives you the cap rate. Okay. Now let's we got another message here. Hang on one second, guys. It's not. Ooh, we got several of them. Okay. Would you consider the increased value after refi as income since you could take it out as investment? So I think what you're asking, Louis, is if I had a property and I've done this a lot, by the way. Let's say I bought it for $200,000 and I improved it, physically improved it, you know, new kitchens, new bathrooms, new roof, maybe a new garage where I rented out, that kind of thing. And I made it worth $300,000. But I went to a bank and refinanced and it appraised at $300,000. Let's say I was able to borrow up to 75% of that $300,000. So that would be $225,000. I could borrow $225,000, which is 75% of the $300,000. Remember, I paid $200,000 for it before. Well, maybe I put down 20% then, which would have been $40,000. So my original mortgage was only $160,000. That means effectively, I take the $225,000, I'd have to pay off the $160,000. I'm left with $65,000. If you're asking, is that income? No, loan proceeds are not income. At least in the States, loan proceeds are not considered income. Okay. Now, if I did not pay back the loan, the IRS would more likely say, well, guess what? That's now income to you. So if you think about the foreclosure business, when somebody has a property foreclosed on them and the loan is forgiven, yeah, the IRS is going to say, well, that's a gain to you. You just realized effectively a gain of whatever the, you know, say $160,000 that you didn't have to pay back. That's considered income. Okay. So in any case, I hope that answers your question. Oh no, capital gain, Louis. So that's not capital gain. So capital gain is when you sell the property, you actually sell the property. Okay. And in the case I gave you before, my capital gain without any other input or variables was $100,000. I paid $200,000. I sold it for $300,000. My capital gain was $100,000. Now there's a lot more to that than that. In other words, if I depreciated the property over 10 years, I made it depreciated, say $50,000. Okay, which means my cost basis is now $150,000. So my capital gain would no longer be 100. The difference between 200 and 300. My capital gain would now be 150 because I depreciated the original cost basis from 200,000 to 150, sold it for 300. So my gain effectively is 150. Now you have to do what's called recapturing capital gains. All right, that's not free money. That's like borrowed money. When you depreciate a property, what you're doing is you get temporary use of those funds to use for other purposes, like investing, for example. But when you sell the property, you've got to recapture it. You got to essentially pay it back, you know, on paper. It's not like you got to actually hand over the money. It's on paper. So capital gains is tempered by recapturing the depreciation. So we're kind of getting way off the tangent for tonight's subject, but these are great questions, guys. You guys are you're making me pull out the old Gary Wilson encyclopedia of my knowledge, which isn't everything. I only know what I know. Okay, so can you please explain where the 227 expenses came from? Oh, so Melanie, we're going to look at that now. Okay, let's look at the expenses. Up here is all the big picture. All right, down here we're going to look at financing. So let's just skip by that past that for a second. Secondary financing, we'll skip past that. Okay, now let's see where expenses are. There should be expenses in here somewhere. Down payments, all financing stuff. Well, I'll tell you what, they don't have an expense column, expense category. See, Melanie, this is why I like the other one too, the one I showed you earlier. Let's see if I can find it here. There it is. So let me do a screen share on this, guys. Thanks for pointing it out, Melanie. So, and this, the version we went over last week, guys, as you can see, this does a pretty thorough job of accounting for expenses, okay? It's pretty detailed, pretty much every category of expense you could ever imagine: property taxes, management, insurance, payroll, repairs, maintenance and repairs, utility costs, accounting, legal permits, advertising, supplies, contract services like lawn care and snow removal. That's pretty thorough. So Melanie, this is what I would do then. If I'm going to use the other calculator, the one we've been working on tonight, I would go in here and I would get as much as possible the actual figures for expenses, put them in here, then take this total, let's just say it's 227, and load it into here where it says 227. So in other words, this calculator does not give us the, I mean, I'm sure it's not on sheet 2 or sheet 3, those are just blank sheets. We'd have to account for that, and this is a broad figure that accounts for all the expenses on that property. I would use the other calculator to do the accounting on the expenses. That's not something I would want to guess on. If I'm doing a pro forma, again, I would use my averages from my past experience. If I'm looking at someone else's pro forma, I'm going to take it with a grain of salt and ask for the actual figures, and I would get rent rolls, profit and loss. So Melanie, on profit and loss, I would get the actual details of the expenses. When I also get Schedule E from the tax return, that would also give me the expenses there in detailed format. So wherever I get them, I would take those figures and plug them in here, okay? Okay, good, thank you. So in any case, guys, that's actually pretty much it. I mean, everything else, oops, sorry, I went way too fast. You can go down here and you can see, obviously, primary financing loan to value. I like, you can plug in 80%, 75%. You can change that. So let's make it 80% and hit the enter key and see what happens. Didn't much happen there. I don't think it changed. It's supposed to change that, by the way. But here is your interest rate, your term, number of payments per year, monthly payments, and your loan constant. I forget what that is. I forget what that is. I'm gonna have to look that up, guys, because I can't remember what that is. Well, let me change this back to 75, because this loan amount used, that's a hard figure. It's not editable. And I just changed that figure. Might need to be worked on. Hey, Doug, we may need to go back and look at this. Yeah, that didn't change unless there's something up here I'm not seeing on the upper part. Let's see, we got the sales price. So sale price doesn't change and we change the loan to value. That should have definitely changed the loan amount. Oh, here. Yeah, why did that not do that? So I would like it to calculate that for me. I don't want to do that myself. I know what it's saying. What's that? Let's go back up here and see the actual sales price, listing price. So 1,568,000. Hang on one second. I'll do this real quick, guys, on the smartphone. Calculator 1568, I think it was 1568. Let me double check that. 1568, yep. Times 0.75. 1,076,000, that's what we got. Oops, got too many zeros in there. Okay. Now, if I made it 80%, let's do that. 0.8. That's 1,254,000. So 1,254,400. Okay. So I would have qualified for a loan at 80%. We can change that now. I would have, if I did an 80% loan on 1,568,000, which was the pro forma sales price, I would qualify for a loan or be eligible for a loan for $1,254,400, but I'm only using $1,776,000 of it. And I've done that before. I bought a building one time while I was approved for whatever it was, 1.2 million, and only used about $1 million. I ended up using the other 200,000 later on for some major capital improvements, like I completely redid the parking lot, replaced all the boilers. I forget, when I spent the 200,000 over the next couple of years, and the banks will allow you to do that. So I was pre-approved for this, I only got that, but over time, ended up borrowing up to the amount that I was approved for. So does that make sense what I just described here, guys? This is more advanced. You generally wouldn't do that unless you were buying bigger buildings that have some major capital improvements. So only borrow what you need to purchase the property. And by the way, banks have gotten in trouble for this. What they would do is they record the lien for the full loan amount, even if you didn't take it all. And let's say you don't use the other money and you sell it. Well, when they go to do the title search on that and they do the payoff, it's going to show $1,254,400. It won't show that. That's happened before, and banks have gotten in trouble for that. Okay. In any case, as you can see, I like this calculator. It's a great complement to the one we did last week. The straight Excel spreadsheet allows you to do comparisons. So, for example, in your booklets, guys, you can use this calculator, this side-by-side what-if scenario for your spreadsheet. If you put in there 5 rental properties, put them all on here, right? Or 6, whatever you want to do. And you'd have to change the column heading so that reflects that. But you can use it for that example too, which is awesome. Way better than the old version we used to have, okay? All right, so Lou's asking, is that a collateral mortgage or a re-advancement mortgage? Basically what you're doing, they're definitely collateralizing the mortgage with the property, Louis. But the other money, the difference between this amount and this amount, the 1,254 and 1,176, the difference there, when you pull it out, they call those draws. And they don't just hand over the money, by the way. You actually have to show them what you're using it for. In fact, they sometimes will send out an inspector to say, well, you said you're going to take this money out to redo the parking lot. They'll actually come out and look at the parking lot and then disperse the funds. Or if you did all the new boilers, they would say they'd want to see paid invoices, evidence that you used the money for the purpose that you said you were going to. So it's like a draw, Louis, on like a construction loan. That's what it's more like, okay? In any case, guys, I think that's pretty much it. So next week, we will go over the property inspection form, the rehab analysis form, and show you how do we do the physical analysis and account for all that. And now you got the financial analysis and you'll have the physical analysis. And any of you can go out there and take any property and do the analysis. I know you might be thinking, well, hey, I've never done this before. Well, this is how you learn. Just go take a property and play, just like we do in the stock market. When I learned how to invest in the stock market, I didn't just go learn and go do it. I actually did models, right? I did practice investing. So same thing here. Take some properties, take ones that have already sold online, plug them in, get all the figures you can and play with it. And this is how you learn how to use these things. Next week, again, we'll do the physical analysis, and that's in the field learning. You just got to go through properties. That's how you learn that stuff. So, Todor, this is what is happening with one of my clients right now. They check him at every stage. Yeah. So it's just like a construction loan, Todor. It's just not, they're not building a house. They're buying an income producing asset that they anticipate bringing in greater revenue at a future date. And the bank will let you borrow against that value, okay? And then the difference between the now and the future is what you borrow in the form of draws. And they'll want to see rent increases. They're going to want to see you actually make more money as a result of all your capital improvements. I mean, it's, you wouldn't, like, we don't replace all those boilers just because we want to have lower gas bills. We do. We cut our gas bills dramatically because they were high efficiency boilers. But we were also able to raise all the rents as a result. So a capital improvement does give you greater equity value in the property, and it should also every time give you greater income. So on paper, I mean, you look like a financial genius. You increased your net worth, and you increased your income in one move, a capital improvement. So, in any case, banks are all on top of this. By the way, guys, there are banks that actually are owned by real estate investors. One of them is called Enterprise Bank. I know some of those guys personally. Let's see here. Oops, hang on one second. Can we send you some ones that we work on to have you analyze them? Absolutely, Melanie. Louis is right. We've done this over the years a number of times. And there's nothing better, Melanie, than bringing one in front of the group. We'll plug it in. We'll turn on people's microphones. Like Louis got a lot of experience. I mean, several of us on here, Shirley's done a lot of this. You can get all kinds of insight. I don't know everything. I mean, there's lots of things out there that I haven't done. So I definitely want your guys' input and insight. So guys, bring me properties, and let's put them up online here. Let's run them through the paddle wheel with all of us investor agents on there. Okay. Let's see. I thought there was another question here. Excellent. Thanks, Louis and Gary. You're very welcome, Melanie. So, okay, guys, I'm going to go visit with some family here. I will see you next Wednesday. And if bring examples, we'll go over them with these tools. If not, we'll go over the physical analysis and keep going from there. I would much rather you guys bring stuff in, because it's like feedback for me that I know you're engaged and you're learning. We got all the time in the world to go over physical analysis. Okay, it's more important that we master what we're currently covering. So, okay, guys, have a wonderful rest of the week. God bless you and your families. Stay safe, be smart. Live life, but protect life too. How about that? Okay, and I will see you next week. Hey, Elsa, set up another call, because I want to see how you did on those assignments. In fact, everybody here, Alicia, Melly, man, you guys should be setting up strategy calls. There's slots. This week's full. Next week, easily 12 slots left over. I just looked at it today. So grab them. Let's get you rocking and rolling. Okay. Okay. Take care and God bless. I'll see you next week. Bye-bye. Recording.